Hello and welcome to the CNBC TV18's Mumbai Newsroom. I'm Sonal Bhutra and with me is Pavitra Parekh and you're watching Mutual Fund Corner. And on the show today, we'll discuss the mutual fund flows for the month of October. But before that, Pavitra, tell us all about what happened in October when it comes to mutual fund data and how did it look?
Okay, so let me run you through that entire wrap. So like you pointed out, the data for October came just a few days ago. And if you look at the equity mutual funds, they have seen inflows drop to around 9,250 crores. Now remember, this is versus the over 14,000 crores that we saw last month in September. But do remember that September had quite a large chunk, around 5,800 crores from NFOs alone. So X of that, it looks quite steady, right, when you compare it on a month-on-month basis. And that is why the September number looks so inflated. Next plate will come up for you. It is on the debt funds. So that has also seen outflows continue. The figure looks much lower at around 2,800 crores versus the over 65,000 crores that we saw last month. Now, this is because liquid funds this month clocked in an inflow of a little over 19,000 crores versus the outflow that we saw of almost 60,000 crores last month. Don't be shocked by the sharp difference. It's actually nothing so alarming. It's just because last month was the quarter end, right, September. So there's some standard quarter end activity and on account of that, you saw a very high figure for liquid funds in the last month. Next, we'll also move on to hybrid funds, which also seen outflows continue. So around 2,800 crores of outflows this month as well. Like you can see, for the past 5 months, we have been seeing outflows in this category. Next, we'll move on to the balanced advantage funds. Now, as we know, these are also called dynamic asset allocation funds, and they've been a very popular category in the past couple of months and even the year, actually. And this category also saw an outflow this time around, and that figure was at 450 crores. In fact, even if you look at last month's figure, there was an NFO, but X of that, there was an outflow. So, it'll be interesting to see how this trend moves going forward. Now, if I move on to the passive funds, the trend continues upwards. So, index funds are up on your screen. This month, we've seen 5,000 crores. That's for October. And this is versus the 2,300 crores that we saw last month. So, there has been, quite a pickup in that space as well. Finally, onto the SIPs. They've done well yet again. Like you can see, it's been steadily going up. And in fact, now in October, we've even crossed that 13,000 mark. So now that's a wrap of all of the data that came through this time.
Okay, Pavitra, thank you so much for making sense of this number, SIPs crossing the 13,000 crore mark. And of course, to talk about this and a lot more, we have with us Mr. Sunil Subramaniam, who's the MD and CEO of Sundaram Mutual Fund. Sir, thanks a lot for joining us and discussing the trends that we are seeing in the mutual fund industry, this time particularly for the month of October. As you heard Pavitra talk about all the trends that we've seen across categories as well, tell us what your initial thoughts are and what kind of steady rate are you looking at?
So I think the first thing is that the retail investor is retained confidence because the SIP book continues to hold strong and has crossed 13,000 crores. So that's number one. I think as a takeaway, if you look at it, there's no, the volatility in the market is not caused a panic in the retail customer. That's number one. Number two, you correctly pointed out that last month was an NFO heavy month. So the inflows of last month were much higher than this month. This month, the NFOs were much, much less. Because last month and the month before, the NFOs were coming after a pent-up gap. Because if you recollect, April, May, June, there were no NFOs at all because SEBI had put an embargo due to the pooling issue. And so there was a pent-up, of NFO launches, which took advantage of that and which is now tapering down. Third aspect which you mentioned is that the balance advantage category and the hybrid category are seeing outflows. So the lesser inflows. In the hybrid, I'm not so worried because it's the arbitrage which has seen an outflow, which is an institutional play. There's about 4,000 crores of net outflows in arbitrage. If you take away that, hybrids were also positive. But you mentioned the sharp correction in balance advantage fund. And so I think that's from the last month continuing again shows the confidence. You see, balance advantage had become a very important category in a time when the market was very volatile, when the FIIs were withdrawing up to June and then the FIIs came back. So the asset allocation recommended by distributors to their customer was park it in balance advantage because you can take advantage of the fund manager's expertise in equity asset allocation. Now, what's happened is fund managers in the balance advantage category have moved from 40% equity allocation to 55 to 65% if you see various balance funds. So the fact that these investors are very smart and they're looking at it, they're seeing the fund managers allocating more to equity, which they're also saying that means my outlook is fairly good for the Indian economy and for the EPS growth. So let me also shift out from dynamic asset allocation into a pure equity. So now when you look at the pure equity collections, though they are lesser than last month, it's a small cap segment, the mid-max cap segment, which are getting a significantly higher share of the flows. So that points again to a greater confidence around the Indian economy. The fact that though the world is going through a slowdown, there isn't that bad news around Indian economy. Inflation trends are coming lower, government's GST and direct tax collections are coming higher. So I think overall there's a good feeling around it, which is where I would say that the sustainability. And finally, index funds and ETFs, you mentioned about the flows, these are institutional investors, provident funds, right, who are making allocations to equity, right? So that again, it indicates that they are bullish on the Indian market. They are choosing index because by mandate, they have to choose the lowest cost option. And hence institutional play is largely reflected in that. And finally, on the debt side, you correctly pointed out that September was heavy outflow on the liquid due to quarter end balance sheet management by corporates and banks. And this month it's reversed back to normal. So I would say overall, you've captured the trends quite well. And this is my explanation for that. So it gives me confidence that in the months ahead, we're going to continue to see positive inflows from domestic investors into MFs. And hence MFs will continue to be buyers and supporting the market's up move.
Oh, we've definitely seen that play out, right? Sunil, even at a time when we talk about volatility or investing in these times, it is these flows which are sort of really aiding the market. On the balanced advantage funds, I just want to ask you, like you said that there has been an outflow this time. Last month also we saw an outflow. And maybe investors are now more comfortable moving to pure equity plays. So do you think this is a trend which is likely to continue?
I think as long as the news, I think the festival season demand was spoken about a lot. I think there's good demand. I think India's inflation trajectory, as you see, is coming down steadily. We have had a good monsoon. We have had all the reservoirs full. So Rabi crop is also slated for a good sowing season. So I think overall, RBI has also projected inflation in the first quarter of the next financial year at around 5%. So this indicates that there's not going to be any interest rate hike kind of pressure on the domestic scenario from RBI. And I would also say that the fact that in the US inflation has started dropping means Fed may ease off on rate hikes, which is a positive for flows into countries like India. So I would say that all in all, there could be continuing volatility for the next 3 to 4 months. But I think that the Indian investor has gained so much experience that he now sees as a volatility as a time to buy stocks low. The buy low, sell high is now coming into play. And more the intelligent investor, right, I think is coming to play in being smart about his moves. So that gives me a lot of confidence because there is no bad news on the Indian economy front. I think the data that I see points to a good outlook for the Indian economy. So I think that this augurs well because FIIs, when they return, will buy large caps. And domestic mutual funds will then sell large caps into the FIIs and start buying mid and small caps. So a broader asset allocation, which is what the investor is also doing by increasing his allocation to mid cap and small cap. So I think overall, it's a good story for the broader market.
It's a good story for the broader markets, but they are diversifying their asset allocation as well. So I was just looking at the marginal growth that we saw in the gold ETFs this time around. It was marginal, around 147 crore rupees with an AUM for this particular fund or particular segment at 19,881 crore rupees. Do you think this is one segment which will start seeing more traction? You are, of course, talking about strong fundamentals, but still there is some volatility that we're seeing in the global markets. Do you think this could be the safe haven for investors? And this is something they'll start looking at more positively from here on?
I agree with you because see, in the periods up to last month, right, as US dollar was rising because of rate hikes by the Fed, gold was suffering, right? But now that you are seeing that the market is expecting an end of the rate hike cycle sometime next year, post which, if they have achieved their targeted inflation coming down, definitely US growth is going to slow down. And I would say that dollar strengthening will be a reversing trend. So when the dollar starts to weaken a relative basis, right, gold will be a beneficiary. And if you see 1 month gold prices movement, it already started an up move. So I think that it's a correlation to the dollar. Dollar strengthening is negative for gold, dollar weakening is positive for gold, and sovereign wealth funds also do this allocation. When they invest in dollar, they put it on the dollar and put it in gold. So that's one important tracker where I would say, yes, gold should form a part of the asset allocation, 5 to 10% maybe, because if this trend of recession continues, you would like to see dollar weakening, then you're going to see definitely gold appreciating. So I would say it's a smart move to have 5 to 10%, not much more than that, in gold at this point in time. The numbers last month also reflect to some extent the Indian consumer Diwali buying. Instead of buying jewelry, maybe buying gold, paper gold, just as a matter of a sentimental thing. So that could also account for a small uptick in gold demand.
All right, got that. That is on the gold schemes. Sunil, just coming back to debt for a minute, like we were talking about last month, of course, looks very inflated because of the quarter-end activity. But how do you expect this to trend? We've been talking so much about being in this rising interest rate environment. Where do you expect to see the debt funds trend in the next couple of months? I'm not talking about just this one, but in the next couple of months.
I think what's happening is that there are two types of debt investors, right? So one is a person who allocates between equity and debt. And there I would expect that debt allocation to be increased in equity because of the increasing confidence. So you will see that balance advantage going out, even that is reflective of that trend, that a greater allocation to equity from a person who's comfortable with both and is planning both. But a pure debt investor, right, compares himself with FDs, right? And within that, there are again two categories. One who's parking his safety capital. That's in the liquid, ultra short-term, right? The other one who treats debt as an asset allocation versus FD and who's looking for a good return. And for that, he needs to have a 3-year view because of the way the taxation is structured. So on a post-tax 3-year basis, given that interest rate hikes have happened, today a 3 locked in. If you're willing to wait for 3 years, I think on a post-tax FD, you're able to get at least 50% more return, which is post-tax FDs are giving you sub 5%, and you will be able to get, say, 6.5%, 7%, which is 35 to 40% as a return better percentage, right? So target maturity funds, right, which are open-ended FMPs in a sort. That is, if you have a target maturity for, let's say, 2027 or 2028, and you stay till then, you will get the yield which the paper is bought at today, which is upwards of 7% today. So if you're getting a 7% yield and with an advantageous taxation, the HNI customers who are looking for no risk but just want to get a better yield than FDs would start allocating more into debt. So I would expect that target maturity funds should get higher and higher collections in the coming months because these rates are good. Because as I said, the inflation forecast is coming down. So further rate hikes from RBI need not be on the anvil. So as a result, I don't see interest rates going too much higher. There will be a slight 15-20 basis points rise in longer term interest rates, which could be factored in. But I would say that for that kind of investor, compared to FD, it's a good time to lock in. So target maturity funds are the funds which I expect to be the favorites in receiving debt allocations over the next couple of months.
All right, target maturity funds could be the favorite. Sunil, thanks a lot for joining us and taking us through that complete analysis of what's going on in the mutual fund industry. But on that note, we're going to get into a short break. When we come back, we'll connect with Anand Dalmia of Fisdom to answer all of your MF-related queries. So stay tuned for that. Hey guys, welcome back. You're still tuned into Mutual Fund Corner, and now we've been writing and asking you guys to send us all of your queries on anything related to mutual funds, and we have a whole host of them. So we have a special guest on our show just to answer all of those queries. Anand Dalmia, who's co-founder and chief business officer at Fisdom, joins us now. Anand, good afternoon, and thank you very much for joining us. This is Pavitra. We have a whole host of queries which have come in for our, for you from all of our viewers. A lot of people want you to also sort of review their portfolio. So I'm going to get straight to it and try to accommodate as many as we can on the show today. The first one comes in from Palash Agarwal. He writes to us from New Delhi, and he's asking if there's any mutual fund in India right now that focuses on the theme of financialization of savings, that is investing in AMCs, in wealth management firms, brokerage firms, and if not, then which mutual fund could be sort of the best proxy to achieve this kind of objective? Anand.
Firstly, thanks, Pavitra. Thanks for having me on the show. Look, this financialization of theme is a very important theme. In fact, Fisdom was created to make sure that, we write this theme. But it's not only limited to wealth management companies or brokerage companies. It's essentially, people saving rather than through physical assets, through financial assets. And I think, it extends to insurance companies. It extends to banks in particular, because they are the biggest beneficiaries of financialization of savings. While there is not a mutual fund which is specifically focused on financialization of savings, but a very close proxy is the banking and financial services funds, which a lot of AMCs have. The one that we like is, offered by SBI and ICICI. I think they come closest because majority of the investment is across banks and insurance companies, asset management companies, and brokerages. And I think, if someone is very keen on that theme, SBI Banking and Financial Services or an IPRO Banking and Financial Services are the right schemes to invest.
Okay, all right. So those are some answers for you, Kailash. But with that, let's move on. Sarath is writing to us from Hyderabad. He has an SIP of 2,500 rupees running in Mere Emerging Blue Chip, 5,000 rupees SIP in Axis Mid Cap Fund, 7,500 SIP in Axis Small Cap Fund, and other investments as well. He wants to know from you, Anand, if he should change his investment plan. What are you suggesting? Because he's actually given you the entire portfolio here.
Look, firstly, I think, the portfolio is extremely mid-cap and small-cap oriented, which looks like the right thing to do. I think Sunil just now highlighted that it's a good time to get into mid-cap and small caps. And we concur with that as well. If your risk appetite is there and you are in it for the long term, I think those are the right segments to invest. However, if I look at one of the schemes, which is the UTI Next 50, I think, part of it can be shifted to an international fund for diversification. Also, NASDAQ at this point of time, which is something that one can look at, a Kotak NASDAQ or a Motilal NASDAQ, offers also value, given NASDAQ has corrected by more than 30% or around 30% in the last 1 year. I think a part of it, or 50% of that moving to a NASDAQ fund would essentially mean that, 15 to 20% of your entire SIP investments will also have an international exposure, given that you already have Parag Parikh, which also has an international exposure. So part of that shifting will just make sure that your portfolio is absolutely correct.
All right, that is on this query, but otherwise the portfolio you're saying is well, looks quite well diversified. The other question which comes in is from Basavaraj S. Bhima Reddy, writes to us from Bangalore. He says that he's a retired government service employee and has a pension which he says is sufficient to manage his monthly expenses. Now, he's also invested in senior citizen schemes and the LIC Pradhan Mantri via Vandana Yojana. He says that he has 20 lakh rupees which he wants to invest, and he wants to know which is the best debt mutual fund suitable for a period of around 3 to 4 years. Anand, come in on this one. We were just talking about debt mutual funds earlier as well, but for a 3 to 4 year period, and he has around 20 lakhs. So how would you advise that he goes about this?
So firstly, he's doing the right thing given his age and risk profile and liquidity needs, looking for a debt mutual fund rather than an equity mutual fund. So I think that's the right approach. Secondly, as Sunil was saying, given the interest rate environment that we are in, wherein the rate hikes are still possibly not over, the best funds are actually target maturity funds, because these funds, you exactly know that today you can lock in a yield, and the yields today are more than 7%, plus you get the tax benefit. So Edelweiss has a couple of target maturity funds which mature in 2025 and 2026. So one can look to invest in those funds, and you get a 7% sort of a yield and optimal tax rates. The other thing that one can look at is the banking and PSU funds. These funds largely on a normal have very low duration. So which by that I mean that the maturity of the papers that they hold is not that long tenure. So they don't get impacted so much when interest rates were to rise, or if at all they rise. So one can look at a part of it into banking and PSU funds. We like the ICICI banking and PSU debt scheme. And I think mostly in target maturity funds is probably the right thing to do at this point of time.
Okay, all right. So that is well thought of advice as well. So I hope the viewer benefits from that as well. But going on to our last query now, Shailesh Singh is writing to us from Pune. He is a salaried professional and investing in various mutual funds via SIP since last 7 years of his retirement. Currently, he has monthly SIPs running in Mirae Asset Emerging Blue Chip, Parag Parikh Flexi Cap, Kotak Emerging Equities, and SBI Small Cap. He has a sufficient debt portion in debt mutual fund and PPF. He wants to add more SIPs for about, say, 10,000 rupees per month, but he says he wants to know whether he should explore value or US-based NASDAQ funds or stick to flexi-cap funds. Anand, you just spoke about NASDAQ funds, but flexi-cap funds, do you think that is the right way to go about it? Should it be a split? Should it be a lump sum payment? What are you suggesting here?
So given that you are, in this case, he's looking for retirement, right? And I'm assuming time away. And his risk appetite is there, given that he's tested SIPs for the period of 7 years. And if he's looking to, and the funds that he holds has a good split of across market caps. So it has large cap, mid cap and small cap. So I would say a flexi cap would put a large part of the thing again in a large cap, which is not probably the right thing for him to do, given the tenure of his investments, his risk appetite, and the financial goal that he's looking towards. From a diversification perspective, I just said, I think, my personal money, I'm starting to put in NASDAQ, given that I think it's very attractive with a 30% correction. And if you're a long-term holding, I think, NASDAQ or US tech is a very interesting place to invest. So it will give you international diversification plus, a value, because that's coming at a value cost today. I think, one should diversify to NASDAQ and not invest more in FlexiCap, his holding.
Okay, all right, Anand. Thank you so much for joining us today and taking our viewers through their queries and answering them so patiently. Well, that's the word coming in from Anand of Fisdom. But with that, it's a wrap on this edition of Mutual Fund Show. But do remember to email us your queries and we'll address them with our experts. Stay tuned for Closing Bell to take you through the last hour of trade.